Hello, I'm Dr. Ron England. This is Module 13, Lecture 1, and we're going to talk about, okay, we're kind of getting away now from a good old time value and looking at looking at different decisions based on the cost analysis of the decisions, and just talking about some of the practical ways that you do business and accounting. And it does actually, I mean, some of the stuff that you see here isn't necessarily real. Taxes are real. You do pay taxes. And you say the two things that are inevitable in life. But what we're going to talk about here is really depreciation, and this is all accounting. So when we talk about depreciation, it's an accounting technique. So let's first pull over here. What do we really mean by depreciation? Well, here's how you look at this. Okay, suppose you spend a ton of money at year zero. Okay, that's an expense. In a business, that is an actual legitimate expense, but you're not necessarily going to take all of that expense value and then apply it in the year that you made the expense itself. I know it seems odd if you're not running a business. If you're thinking about, let's say you bought a car and you paid in cash, you say, well, that is an actual expense. That comes right out of my income for that year. However, in a business, you want to actually take that cost and you want to actually show it in multiple years. Same thing when you're talking about, so basically you're going to subtract it from your income. It's an actual cost. That's also important because that's how you calculate how much you pay in taxes. Taxes are paid on income. If your income is lowered, and because you have a cost of an item, and what we're talking about is income is net income. Net income being, hey, here's a ton of money you made, here's the money that you went out minus in, that is your profit, profit gets taxed. That's simple. So, depreciation. Now, first thing is that you can't depreciate everything, but if you depreciate something, you're saying, well, what I'm going to do is I'm going to say that this item loses value over time. And that loss of value is going to show up as being subtracted from the income that I report on my taxes and also on financial reports. So it's a business expense, and it's an important business expense in that it reduces taxable income. Now, when we're looking at this from the perspective of engineers, we're pretty much going to be looking at the taxable depreciation. So if you have an amount of income, income minus expenses is taxable income. I think anybody who's ever done a W-2 can show, that you actually take, here's your income, you subtract these things which are deductions, that gives you your taxable income, and you pay taxes on that taxable income. Okay, well, depreciation, you got income, subtract the expenses, that's going to be the cost of the materials that you have for goods, operating expenses, and depreciation of capital items. Capital items are just basically big items that can be depreciated. That gives you your taxable income, which you then subtract the income taxes, and then in the end, you've got your profit statement. Now, you can see why there might be a difference between what we call the book depreciation and the taxable depreciation, because taxable income minus income taxes is your net income. So the concept is pretty straightforward. You've got really two pieces of depreciation. The reality is that things that you buy are going to have a lifespan that's associated with them, and you're going to have to replace them at some point in the future. So you have the amount of money that you paid for them, you have their salvage value, so the difference between those two, which does have a time component associated with them, but the difference in those two, knowing that there's a difference, okay, and you can depreciate that difference. Now, how can we think about this? Well, suppose we paid $20,000 for a car and we drove it off the lot, and a year later the car's only worth $15,000. That's its current market value. Well, that's an economic loss. Now, the economic loss of a car is probably going to be the economic loss because it's just not as valuable anymore. It has some deterioration because you've been driving it around. It also might potentially have some technological obsolescence. I think if you've ever driven around in a car from the 1970s, you know that their cars today have a little bit more technology. But if you're not talking about cars, if you're talking about equipment that you need to run your business, there is a technological obsolescence component. Also, the fact that, guess what else can be depreciated? Computers. So, how are we going to do this? We need to come up with a number that we can subtract. Let's just go one step further and let's look at this. Okay, so you've got this depreciation of the value, gradual decrease in the asset. It physically depreciates. It doesn't last forever. So it might, it's losing value. So that's basically the whole concept there. It physically might not work as well anymore. Okay, it might not have the functionality that you need. And there's two types that you're talking about in accounting. When you look at accounting depreciation, there's the book value and the tax depreciation. They're both important because companies are required to do financial reports on a regular basis. And that book value, okay, is used in the financial reports of the company. The tax depreciation is also important because it's used to calculate what you owe in taxes. Now, companies can depreciate things, but so can individuals. The rules for how companies depreciate and the rules for how individuals depreciate are pretty much a lot of the same rules. So, what do we mean when we actually say, okay, well, how do we figure out the depreciation? Well, first thing is you got to kind of have to know how long this thing is supposed to last. And at the end, you're going to have some sort of salvage value. It might be zero, okay, but there might be a specific value to the asset at the end of its life. So you're going to look at, actually, there's different methods of depreciation. We're going to talk about those, and the cost basis. Now, what do I mean by cost basis? Well, when you have an asset, there's actually more to just the cost of the asset. If you buy a piece of equipment, the piece of equipment might have to be installed. That is a cost. That is also can be summed into the total cost of value of the thing that you're depreciating in. So you have a $10,000 piece of equipment that costs $5,000 to have installed. Well, it's a $15,000 piece of equipment now. And there might be other costs associated with it, but it's just that just kind of gets the whole point across. It's not just the cost of the piece of equipment. That $15,000 can be depreciated. And we're going to talk about there's some simple methods of depreciation. Most simplest being just straight line. Here's how long the thing's going to last, beginning, end, divide by number of years. Okay. Well, the rules are important. So here are the rules. These are simplified rules. If you want to read tax law, have fun, but let's just kind of put it in simple terms. What can you depreciate? Assets used in business are held for production of income. Okay. Having a definite useful life of longer than a year, and things that will either wear out, become obsolete, or lose their value over time. All of those. If you meet those three conditions, which a lot of things do, okay, they can be depreciated. And that's something that you would want to do. Now, let's see, cost basis. Well, let's say we buy a piece of equipment and it's got an invoice price, and you can see it's here shown. It's just kind of the same thing that I just said. Well, it's going to cost you some money. You got to have it shipped to you, so the freight can be put into that cost. The installation, okay, that can be put into the cost, and maybe you have some site preparation. All those things that you need to be able to operate that specific piece of equipment can go into the cost of the equipment that can be used in the depreciation calculation. And yes, this is stuff that is in statute. It's in law. Good old, beautiful tax law. So if you were looking at things now, if you have, let's say, a trade-in allowance that goes with this, you kind of notice that there's this thing called an unrecognized gain here, which actually has to be subtracted from the overall piece to make that cost that you can use for the depreciation slightly less. Yep. Now, those are just going to be numbers in this case, as we're actually talking through the kind of problems that you'll solve for this class. Those will be things, just numbers that are given to you, a trade-in allowance. But remember, the trade-in allowance actually gives you an unrecognized gain of a certain amount over the actual book value of the previous piece of equipment, which then becomes an unrecognized gain, which actually ends up getting subtracted for the amount that you can depreciate, which you can kind of see here. They go in different directions. Now, what are some things you can depreciate? Well, one thing about depreciable items is there's a lot of guidelines that go with the items that you can depreciate. So, and I always find this absolutely amazing here. Office furniture has a lower and a higher and a midpoint and an upper limit of depreciation range than airplanes. Okay. Right. But barges last a long time. Trucks, buses, automobiles, there's all sorts of equipment. I don't think, and if you actually are buying telephone distribution plants, which I don't even agree with telephone distribution plants because who's using telephones anymore in the first place? Yeah, I see that as but these are numbers that are there. They are in the set of guidelines that go with depreciable tax and depreciation ranges for different types of objects. Now let's talk about first two types of depreciation. First, companies produce annual reports. In the annual reports, they're going to report depreciation. And if you've got shares of companies, you'll actually see these reports, the financial reports, and you'll see assets and liabilities, and you'll see depreciation as line items on that specifically. Typically, if you're doing just an annual report, they typically make it one page of each, and you'll show all the depreciations of all the different pieces of equipment they have as a specific line item, not detailed out by individual things. That's the financial report, and book depreciation is what's used there. Tax depreciation, on the other hand, is what has to be reported to the IRS, which is then used in the amount of taxes that are owed. So, in this class, and in most of your engineering world, we're going to use tax depreciation. However, the methods for calculation of book depreciation are also used for tax depreciation, which makes your life simpler. Plus, we're really not interested in you becoming tax accountants. We're more interested in you at least just understanding the methodologies of this because it does make a difference in the decisions that you make in purchasing engineering equipment. All right, so let's look at some of the methods to actually calculate the depreciation. We got three. We're only going to talk about three. First one, simple, straight line method. The next one isn't that simple. I mean, it's actually not complex, but at the same time, it's one of those things that accountants made up, and it's kind of got a unique, that's the declining balance method. And then the other one is actually relatively self-explanatory when you say the unit production method, and you'll see that with the calculation. So the straight line method, we just basically say you got something that's got an initial value, okay, that amount of money that is the depreciable amount minus the salvage value over the number of years, and that's going to be the depreciation. It's just linear. The book value is just simply solving for how much is the asset worth at any specifically point in time based on its straight line depreciation. Just solving that equation that you see for annual depreciation, but just think of annual depreciation as simple. You've got the initial value that it can be depreciated minus the salvage value and then the lifespan, and you take the difference in the two and you divide by that number of years. So this is a good example, straightforward. Say you have your annual depreciation each year. If you got 5 years, it's I is the initial value, S the salvage value. That means 8,000 over 5 years. That means 1,600 a year. Subtract 1,600 a year. That's your book value any given year. And at the end of 5 years, it's going to go down essentially to 0. There you go. Now, this is an accounting method called declining balance method. And the most common of this is called double declining balance. So you've got this factor called alpha. Alpha is 2 times 1 over the number of years. Okay, well, it's 2 times 1 over the number of years in the case of double declining balance method. In other words, we use the value of 2. So the depreciation is basically going to be that alpha factor, okay, times the book value. So the number of years is still important. Now, one thing to note here is that if you use this methodology, you might depreciate the thing to its salvage value before the end of its useful life. That means at some point we're going to have to adjust for that. Or not, just depreciate early. But let's just do a simple calculation. Okay, now, same thing that you had before, but in this case, okay, I is 10,000, S is 2,000, so it's $8,000. You've got a book value of $10,000 at the very beginning. Now, 2 times 1 over n is going to be 40%. Okay, 0.4. Now, 0.4 times the initial book value of the item in year 0, which is $10,000, is $4,000, 40% of 10,000. Okay, so that is the depreciation in year 1. Okay, not a problem. Subtract that 4,000 from the book value. Now you've now got 6,000 left in the book value. Next year, same thing. You're going to take 40% of the book value, subtract that. Okay, yeah, that's your depreciation. Subtract that piece, and so on and so forth. But if you notice here, we've depreciated the entire thing out, and in year 3, the book value is $2,160. Well, here's a problem. You cannot depreciate the value of an item below its salvage value. Once you hit that salvage value, you're done. So in year 3, when the book value is $2,160, well, if you go 40% of 2,160, you get more than 160. Remember what I said, you can't go below its salvage value, which is 2,000. So in year 4, depreciation can only be $160. And then in year 5, you aren't going to get any depreciation at all. Well, you can do that. Or you could do this. Okay, we could potentially switch our different depreciation methods at a specific somewhere along the route. So, okay, how would you do something like this? Well, in the case here, without the switching, you're going to go below the book value of what we saw in that previous example there. But let's just say that at a specific midpoint of a year, we're going to do part of it with straight line and part of it with the depreciation as before, the way that we were doing with the DBB or DDB, declining balance. Okay, so here's the thing that you want to do. One is you want to be able to depreciate the entire value of the asset. Okay, now we're looking at this with the salvage value of 0. This is the case now that we're looking at here. I was talking about the previous case, but now let's talk about this one. If you were just to depreciate 40% each year, well, just theoretically, because you're depreciating 40% of the book value, you're going to take longer than 5 years to get to a book value of 0. In fact, you're never going to get to a book value of 0. It's just going to go down a little bit. I mean, it's going to go down 40% each time. So in this case, we went in year 4 and we switched to straight line depreciation. The other possibility is that you depreciate prior to the end of the life of the piece of equipment. So here we go. Here's the calculations that you've got with the salvage value of $2,000, depreciated $4,000 year 1. Okay, well this is actually just we didn't switch here. Remember, we can't depreciate below salvage value. So looking at the case that we have right here with the depreciation of $4,000, and then we get down to year 3, we're down to book value of $2,160. However, if we do the 40%, it's $864. You can only go down 160 more. What's the point? Let's go back. What's the point of this? Can't go below the salvage value of the piece of equipment. However, you would like to depreciate it fairly over a period of time. Now, business decision. You can do the calculations. We're going to tell you which way it's going to be depreciated in problems that I give you, but in the end, it's a business decision. So, who's going to be making it? Well, if you're the businessman, you will. Or potentially, you'll consult with your accountant who will advise to say, we recommend that you use this depreciation at this stage. The last one, unit of production method. Now, this doesn't have anything to do with time. Well, it does have something to do with time because you actually have to calculate it at specific points in time. However, let's say that you have service units. What exactly are service units? Well, I can give you an example that works really well for service units because we can talk about the example of a vehicle. Okay, or we can talk about the example of units produced. But let's do the first one first. All right. Let's say we've got a vehicle that we say has a useful life of 250,000 miles. And we use, in a given year, 30,000 of those miles. So, still got the I minus S, 55,000 minus 5,000. Okay, that's the actual values that are associated with it. And the depreciation for that year would be the number of service units for that year over the total number of service units. Not hard to do. Just know what the service units are measured in, and that's your depreciation for that specific year. Like I said, unit production is not hard. Straight line is not hard. And for the most part, neither is the other methods. Okay, let's go back up to that. So neither is the declining balance method. But there's just some caveats to using them, and there's also the opportunity to switch between, like in this case, the declining balance to the straight line. Okay, so it's kind of make you aware of those things. And again, the nice thing about these is they're not tremendously challenging. Okay, the calculations aren't. Okay, but it is driven by the statute. There are specific rules that you have to follow. And I'm not going into depth with all of those different potential rules because we're just going to tell you what they are for the type of stuff that you're doing. But when you're actually working in real business, you kind of have to be aware of those rules. Or you have to have somebody who understands the accounting and tax accounting to be able to tell you of those rules. Either way, of those rules is important. That's it. I'm going to stop right there. Hopefully you really enjoyed this riveting lecture on depreciation. Thanks. Bye.